Good afternoon. I want to thank everybody for logging in today to our webinar on what you need to know about investing in tax liens. We have a great guest on hand today to really dive into the world of tax lien investing and give you some great information, and really to get, whether you're somebody who's just looking to get started or somebody who has been investing a little bit in tax liens already. I think you'll get a lot from today's speaker and guests that we're happy to have on. Just as we go through the webinar today, we are always welcoming any questions that you might have. Just please type your questions into the chat box on the screen. We'll make sure that either myself or our guest host and presenter today will get to those questions as we move along. So you can type those questions in. If we have too many questions, unfortunately we may run out of time, but we will do our best to get to as many of those questions as possible. So today's, again, webinar is on what you need to know about investing in tax liens. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I'm a licensed attorney by degree, and I've been with the company for a number of years now, helping people invest in a lot of different types of assets using their self-directed IRA account. Certainly tax liens and even to some extent tax deed investing, something recently we have seen a lot of. And so that's why we really wanted to have our guest host on today to talk about what she does and give you and share some of that information with you. Now, just a quick disclaimer about Advanta IRA. We don't provide any legal, tax, or investment advice, and we also don't endorse any products. And we're not affiliated with any other company, including the guest presenter today. We provide a lot of educational content, and we bring guest speakers on to share their knowledge, but it's mainly for educational purposes. If you need a referral, though, to a tax advisor or a legal advisor or even a financial advisor, we're happy to provide some of those referrals as needed as well. So please just reach out to us. We'll make sure that we get those to you. For those of you who are unfamiliar with Advanta, just a little bit about who we are. We're a self-directed IRA administrator. I'll talk a little bit more in a second about what that exactly means as far as self-directed IRAs. I know many on the call are already familiar with that. We hold over $1 billion in assets for our clients in our two main offices, one in Atlanta and one in the Tampa Bay area. And we really focus heavily on the customer service aspect of our business and giving every client who works with us a one-on-one relationship for anything they need regarding their self-directed IRA account. We also are very committed to the education aspect, and that's why we have, again, a guest on today. We have other webinars, other live seminars in our offices throughout the year, either whether it's this month or even into next year. We try to bring a lot of different and good content, whether it's a live event at one of our offices or even the online webinars and trainings like you're watching today. We record a lot of those trainings for people to watch later, and some of you may actually be watching the recording right now on our Advanta On Demand channel. So I would encourage anyone who's looking for more information about self-directed IRAs or to see even some of the other guest speakers we've had in the past, you can go to our Advanta On Demand channel. And for anyone who's listening live today, you'll be able to go and actually listen to this recording when we post it on our channel in a few days as well. Now, just quickly to talk a little bit about self-directed IRAs before we bring our guest on. Self-directed IRA, for anyone who's on the webinar has not heard, it's the ability to use your IRA, your individual retirement account, or maybe an old 401k to invest in assets that you know and can control. Our clients use their IRAs to invest in a lot of different types of real estate, mortgage notes, private placements, foreign currency, and obviously tax liens, as we're talking about today. But the term self-directed simply means that you're in control. Now, the IRA accounts themselves are still either traditional or regular IRAs, as well as solo 401ks, etc. But self-direction, really, the moniker self-direction and that modifier is simply the ability for you to control what it is that you want to invest into. People typically choose to self-direct for a couple of different reasons. Sometimes it's one or more of these reasons. For a lot of times, it's people finding a different source of capital, basically, for investments or assets that they're already familiar with. So in the context of today's webinar, someone who is already investing in tax liens with their personal money, who's already buying and selling those types of assets, their IRA simply provides a new source of money, new source of funding for them to go buy their next particular tax liens. Other clients, it's the ability that the gains inside of an IRA account accrue tax deferred or even possibly tax-free with a Roth IRA. So if you are investing in tax liens and whatever return you are making back into your retirement account, that is not taxable to you at all on your current tax year. So depending on the brackets you're in, depending on what you're looking to do, you want to certainly make those investments inside of an IRA account. Now, another reason people look to invest is that they're frustrated or scared of the stock market. They want to be in control. Obviously, we've seen some dips recently in the market. Obviously, that's a little bit of a concern for many people as well, that their IRAs, their old 401ks are sitting in a market that they really have no control over. So, again, the types of IRAs, the types of plans that we have, traditional or Roth IRAs, simple IRAs, any former employer plan can be self-directed. And moving money between those accounts to a self-directed IRA is very simple. It's a matter of either doing a transfer from IRA to IRA as a non-taxable trustee-to-trustee transfer. You can do those as often as you'd like, and in partial amounts. Self-directing is not an all-or-nothing proposition. We've had a lot of individuals who have IRA accounts with a brokerage firm, with a bank, that they move portion of that money over to make a particular investment using the self-directed IRA account. Similarly, so transfer is IRA to IRA. Direct rollovers are simply moving money from an old 401k or 403b type plan into a self-directed IRA. Typically, those transfers happen within 1 to 2 weeks. Just depends on your custodian ultimately to decide whether or not, obviously how quickly that's going to happen. No, the types of assets that we have at Advanta, they're very diverse. Again, we're very heavy, I guess, or our clients, I should say, are very heavy into real estate. Individuals investing in rental properties, whether they're buying a rehab or a flip, investing in multifamily or commercial real estate. A large number of our clients investing in private notes and mortgages that are also tied to the real estate space. Probably 70 to 75% of our business and what our clients hold is in real estate. Again, whether it's a rental property, rehab, a note, or mortgage. We see a lot of other kind of private placements, hedge funds in the private equity space, maybe not really tied to real estate. But again, we see a lot of mobile homes, mobile home parks, the multifamily investments, the LLCs that are capital raising mechanisms for real estate. And certainly, as we're going to talk about today, we've seen people invest in tax liens. Now, the common thread with all of the assets that we hold at Advanta is simply that a brokerage firm like a bank or a Schwab or a Fidelity, those companies don't hold or not willing to hold these types of assets in an IRA. Now, the IRS is perfectly fine with you making this investment, but you have to have a custodian like Advanta to make it possible. So if you're looking at investing in tax liens and you have IRA funds that you want to use towards that purpose, using an account at Advanta will help you make that investment, keep your IRA tax protected, and then obviously have the gains coming back as well into your IRA tax-free. Now that's kind of my portion of today's webinar. I want to talk kind of just introducing self-directed IRAs. Again, I assume a lot of the people on the call are familiar with it, with self-directed IRAs. If you're not, again, our YouTube channel has a lot of great information, other webinars that get in much more into depth on self-directed IRAs. But at this time, I want to introduce our guest host, Chantelle Owens with the Georgia Tax Lien Bootcamp, who's really going to share a lot of, again, great information about investing in tax liens. Now, again, she is based in Georgia, much more familiar with the Georgia tax liens. So a lot of the information might be skewed a little bit that way, but there's a lot of other great information on tax lien investing regardless of where you're located to really learn a lot today. So Chantelle, how are you doing today?
I'm fine, Scott. Thanks for having me on. I'm happy to be here.
Good. Well, great. I look forward, and I'm sure everybody on the call looks forward to hearing what you have. So I'll turn it over to you.
All right. Well, thank you. All right. I hope everyone is well. I'm going to go right ahead and jump in. I know everybody's on their lunch break, so I'm going to try to get through this information and give you time to answer questions. So, again, welcome to the Georgia Tax Lien Bootcamp, and I am Chantelle Owens. And just as Scott had a disclaimer, I also have a disclaimer. I am not a lawyer, I'm not an accountant, and the information that I'm presenting today does not establish those relationships. Should you need informed counsel, please seek that counsel. So, all right, now that we've gotten that out the way, let's jump right in. So I hope many of you can see this big fat check on the screen, and I always like to put this check up here because it really catches people's attention and it really gives you an idea of what you can do with tax lien. So this comes from a purchase that, a sale that my partners and I actually sold a property that we purchased in the tax sale to one of our tenants. This is the first sale in the last 10 years. So most of the properties that we buy at the tax sale, we actually buy and hold. But this, regardless to what your strategy is with tax liens, whether it's buy and hold, fix and flip, or wholesale, you can see what is actually possible. Because this is a property that we actually purchased for $4,500. We put about $55,000 in it to bring it up to rentable standards. We had a tenant in it for 2 years that was paying $1,200 a month, and then we eventually sold the house to the tenant because she really wanted to buy it. So this is actually what's possible. All right, well, I'm going to go really fast through these next couple of slides that basically describe me. I usually use these slides to qualify me as the person teaching your class, but you'll be able to go back and watch these slides. But suffice it to say, I have been a real estate investor for 20 years. I have gone through pretty much every facet of real estate investing in those 20 years. And the last facet that I came across was tax liens. And so since that time, I have chosen to only invest in tax liens. I'm pretty spoiled with tax liens because tax liens typically are the lowest point of entry that a person can purchase real estate. And so I'm obviously spoiled with the low prices of tax liens. But how I actually got into tax liens is I went through 2 market crashes, and in the second market crash, I had inventory that went into foreclosure, or at least I thought it had gone into foreclosure. The banks actually did not foreclose, and therefore the property taxes were never paid. The bank didn't pay the taxes, and I didn't pay the taxes. And that property went into a tax sale. And when I was contacted in reference to that property, I actually went back and was able to redeem that property, or redeem meaning pay the investor that won that property at the tax sale what they paid at the tax sale plus 20% in order to redeem that property. And from that point on, because I had knowledge in real estate, I was able to reverse engineer the process and realize that I actually, was sitting on a gold mine. And so that is my foray into tax sales. But in the last 10 years, I've been investing in tax sales, and then recently in the last year and a half, I've actually been teaching others how to take advantage of tax sales to create, whatever their goals are, whether that's to retire, whether that's to live a certain lifestyle, or if it's to, create lump sums of cash. So I've worked with several organizations, and I've taught many students. So I always like to talk to people about wealth, because you can actually create wealth through tax liens. I always ask people to ask yourself a question about wealth and see where you stand in that line. So can you actually take a day off work, not have to ask anybody, and not skip a beat financially? And if you can do that for a day, then ask yourself, can you do that for a week, a month, a year, a decade, or even forever, right? And then if you can do that forever, is this a legacy that you can also leave your children? And not necessarily that you wouldn't want your children to have to work, but would you want to put your children and their children in a position where they can choose what work they want to do, or they can choose, what lifestyle they want to live? And so this is actually obtainable through tax liens. All right, so today I'm going to talk about 3 secrets that everybody always wants to know about tax liens. 1, how to compete against the big boys and win, because this is the number one thing that I hear that intimidates people and holds a lot of people back from getting into tax liens. But there is a way to overcome that. Number 2, how to access properties that you can actually afford in the tax sales, because many people always ask me, are there still properties left that you can purchase? And then 3, how to obtain properties without displacing families, because this is a huge concern for a lot of people. And so you can structure your business model around this if this is an issue for you. So this is the property that actually me into tax sales, right? So this was my silver lining. Desolate time for me. Properties off. Even this one, or so I thought, had went into foreclosure. And so this is the property that I told you did not actually go into foreclosure. So someone purchased this property at auction for $2,100. I always like to pause right there because I know a lot of people have trouble believing that, but this is actually true. This house at the time was valued at $90,000. At one time, it had actually been valued at $140,000, and that was what I had a mortgage on it for at the time it went into the tax sale. So someone purchased this house, and I was able to purchase it back from them for $2,100 plus 20%, right? And so once I did that, I began to reverse engineer this process. So let's take a look at the process.
Hey, Chantelle, Chantelle, do you want to just quick introduce, because what something you just said, somebody had a question on. I want to make sure that we maybe get this out of the way. This question, somebody said, you can buy back or redeem the tax lien at what they paid plus 20%. The question someone said, I have heard that there are rulings that will limit the amount to redeem is limited to the actual tax amount and not what the final bid amount was. I don't know if you can speak to that briefly. I don't know if you need more clarification, but that was a question we had. I know you just mentioned that again. I wanted to clear that out. So the redeeming what they paid plus 20%, or is it limited to the actual tax amount? I get that's
right.
That was the question.
Okay. So obviously every state is different, and so today we're talking about Georgia, but most states pretty much have that same law. So typically it is what is paid at auction. So there are some caveats around that, which one exception to that would be if the county made some type of error in bringing that property to the tax sale, then that can actually be challenged. The other thing with that is that whatever was paid over the amount of the initial taxes that was owed to the county, then the original homeowner can apply for that overage anyway. But in the actual redemption process, they, in order to redeem the property, would have to pay what was paid at sale plus the 20%. So if the back taxes was $1,000 and then that property was bid up to $10,000, the property owner wanted to redeem the property, they would have to pay the investor the $10,000 plus 20%. However, once they did that, or even before they did that, at any time once the county had collected those funds, they could go directly to the county and apply for the overage. Would be the difference between the $1,000 that was owed to the county and the $10,000 that the actual tax lien investor had actually won the bid for. So that would be an overage for $9,000 that they could apply to the county to obtain those funds.
Okay, thanks for that. I'll let you continue on. Just encourage anyone, if you have other questions, please get them typed in, and we'll make sure we try to get to them before the end of the presentation. So.
Okay. All right. So just so that we can start and understand how this whole process starts, let's take a look at why tax liens are created. So tax liens are created for one reason and one reason only, and that's to collect delinquent property taxes. And so some people ask the question, why is that so important? Well, it is important, and it's so important that each state implements an actual law in order for the tax commissioner to be able to enforce this. And then the tax commissioner actually takes on the power of the sheriff in order to enforce this. In many states, the tax commissioner will also be known as the ex officio sheriff, so that they have those same powers. But the reason why this is so important is because property taxes in most places make up 60 to 70% of any county's budget. So that budget goes to create schools, pay those teachers, create roads, parks, libraries, government buildings, and government officials. So that's lawyers, judges, doctors, policemen, firemen, all those county workers have to be paid. And so that is where predominantly the budget to do so comes from. And so this is why it's so important. So let's look at what actually happens when taxes are not paid. And I do apologize because I don't have all the fancy bells and whistles that I usually have with my my deck, my presentation deck. But basically what happens is the taxes are past due. Once the taxes are past due, the tax commissioner has to collect by law. They are under criminal penalties for not collecting property taxes. So they have to do so. And if they cannot collect in cash, they must collect in parcel, meaning parcels of land, and whatever improvements sit on top of that land they can collect. Once they collect that, or levy is actually the word, they can then put those parcels into auction for sale to collect whatever money is owed and due to them. So that's how that process works. So a lot of people always ask, so what is a tax lien? And tax lien is like an umbrella or a category that houses tax lien certificates and tax deeds. So let's just take a look at those. Tax liens are actual liens that are already always present on every parcel in the United States, right? They are invisible, so most people are not aware that they already sit there. But if you want to see them become visible, or perhaps you don't believe me, try not paying your taxes and you will see it become visible. And when it becomes visible, it becomes superior to all other liens on that deed or on that title. So when I say all other liens, that means all other liens. So that means it will supersede a mortgage, an IRS lien, a state lien, a mechanic lien, an HOA lien, a creditor lien, and any other type of liens that you can think of. The only other liens that may sit equal to it would be other county liens. So that could be like a special tax assessment or any other judgment the county may have placed upon that property. So that's how tax liens actually work. Now, tax lien certificates are a category under tax liens. It's a type of tax lien, and it's actually a certificate. So you receive a piece of paper that typically will say certificate on it that's going to entitle you, the bearer, to receive interest. And that interest typically is going to be an annual percentage rate. So it's going to be accrued interest. So if you have a tax lien certificate that entitles you to 12%, you're typically going to earn 1% per month. So if someone redeem meaning they come and pay you those amounts to retrieve that property, they're typically, let's say if they redeem in month 3, then you would have accrued 3% interest, right? So that's how tax lien certificates work. And they typically do not give you any interest rights in the property. And most of them, depending on the state, there will be another process if someone does not come to redeem that you can partake in to actually receive ownership interest. And that could be either the property would go back into auction, and now you can go into that auction, and you may have first right of refusal of any other bids that you can actually say, no, I want to bid. And then in some states, you can just apply to the county at that time to receive the actual deed. So that that actually varies from state to state. Now, tax deeds are actually deeds, so they typically do give you some form of ownership right. Now, in most cases, that is going to be a very low ownership form. And so the highest form of deed ownership is a warranty deed. A warranty deed typically is going to allow you to obtain title insurance, or is going to the seller or whoever gives you that deed is basically saying that I warrant that I had the right to sell you this property, and if anyone comes and challenges that, I am going to defend that. So that's typically the highest form of deed that you can have, and that's how most people purchase property, especially owner-occupied property. A lower form of deed that you'll see is a quit claim deed, QUIT, not QUICK, because I hear people say quit claim deed. But a quit claim deed is basically saying that if I give you a quit claim deed, I am basically saying that I am quitting my claim in that property, and I'm giving no warranties that I had a right to sell that property. So that's one of the lower forms of deed. Well, a tax deed is just going to sit just above that. And basically a tax deed is a type of deed that is called a defeasible deed, meaning it can be defeated. Someone can come and defeat your right in that deed. And in the case of a deed, if they do so, they must compensate you what was paid at auction plus whatever percentage you're entitled to via that state. Now, in a lot of states, there is no redemption period once you purchase a deed. So once you purchase that deed, you will own the property outright. And so then if you want to obtain a higher form, typically there will be additional legal steps that you must complete in order to actually obtain a warranty deed. All right. So let's look at tax liens by state. I know we have people from different states here. So I personally am in Georgia. So if you look at Georgia, we have what is known as, we are a tax deed state. However, you do see an asterisk, so we do have a funny type of deed, and I'll be discussing that a little bit later. But for those states that you see deed in blue, those are your typical states that if you receive the deed, then you actually have ownership rights in that property right away. Then tax lien certificate states, those are the states that I discussed. You will receive a piece of paper that entitles you to interest, and we'll be looking at that a little bit further as well.
Chantelle, another quick question pop up, and I'm sure this is a question that a lot of people might have. Said in your experience over the years in buying, tax liens, what percentage have been redeemed before you got ownership, or what percentage did you actually then were able to acquire the property?
Okay, so there are property tax investors, people who want the property, and then there are interest tax lien investors, people who actually want the interest. And so you have two different models of investing. So I, for the most part of my tax lien career, have been a property investor. So I actually wanted the property. And so for me, in my model, I buy the most ugly house you can think of. And so really, I also buy predominantly vacant properties. And so my personal redemption rate is very low. So in the last 10 years, I've only had 3 redemptions. So my redemption rate, is less than 1%. And so, it just depends on your actual model, because obviously if you're an interest investor, you want people to redeem. And so there are steps you're going to be taking to make sure that that happens. So ultimately, the answer to that question depends on what your goal is.
Okay, okay. Thank you. We'll continue on. Again, if anyone has questions, please get them typed in.
All right. So let's talk about the secret billion-dollar industry. How many of you actually knew that tax liens is a billion-dollar industry? I'm sure many of you assume that, but I bet most of you didn't know that it's $1 billion per day. industry. Not per year, not per month, but per day. And that's a quote actually coming from J.P. Chase Morgan, who, as you can see, banks are the number one investor in tax liens. Many people don't know this because they don't actually invest in their name. They actually create funds or loan money to other institutions to invest in tax liens. And so let's take a look at why banks invest in tax liens. So this is a table that shows you, based upon state, how much interest you can earn from tax liens. And these interest rates are actually state mandated, so they're backed by state law. And so tax liens are an actual anomaly because they are a high-yield investment with a low risk. And so typically those two don't go together. Typically, if you have a high yield, you will have a high risk. And so this is why banks love investing in tax liens. Actually, tax liens are their number two investment. So insurance is the number one investment, and then tax liens is the number two investment of most big banks. And what they typically do is they take your hard-earned dollars and cents that you deposit in your checking, savings, money market accounts, CD accounts, and they go invest in insurance and tax liens. And this is the rate that they receive for those investments. And you can ask yourself, how much of this interest do they give you as a return in your account? And I'm willing to bet that most of you are receiving less than 1%. So this is what they do. So you can actually take your own hard-earned dollars and invest in tax liens as well. So I talked about property investors, but there's also interest investors, people who actually want the interest. And let's just take a look at why someone may want that interest. So there's a rule that a lot of wealthy people know about. It's called the Rule of 72. And basically it explains how long it will take you to double your money at any given interest rate. And the formula for that is to simply divide whatever interest rate you're receiving from your investment and divide it into 72. And that will tell you how many years it'll take to double your money. So in the case of Georgia, we received 20% interest on redeemed tax liens. So it would take 3.6 years if that redemptions were one a year, or you could have 3.6 or let's just say 4 redemptions in 1 year, and you would have doubled your money. And so there are people that actually do that, and that is actually perfect for people who have retirement funds because your funds are going to sit there anyway, and so you might as well give it a chance to double, right? So this is what you could actually do. So let's take a look at tax deeds in Georgia. I apologize for all those people who are from other states, but we're going to examine tax deeds in Georgia today. But feel free, if you have questions about other states and I know the answer, I'll go ahead and answer it. And if not, then I will, just let you know I don't know the answer to those questions. So tax deeds in Georgia are actually known as redeemable deeds, meaning that the investor can actually purchase a deed. They do get interest rights, but those interest rights can be taken away or redeemed by the original homeowner. So in Georgia, you will hear people say that there is a 365 redemption, 365-day redemption period. That is actually not true. Any person owning property has to infinity to redeem the property. It is just that the investor themselves cannot start a foreclosure on that right to redeem for 366 days. So the investor has to allow 365 days to elapse before they can begin the foreclosure process. However, let's say they did not start a foreclosure process for 3 years, then the original homeowner will have 3 years to redeem. So the redemption period does not automatically stop on day 365. it does not stop until the foreclosure process is actually completed. So let's see. So one of the biggest impediments that most people to have as getting started as a real estate investor is money. And this is where your retirement funds can really be of a benefit, because you can use those funds to invest in tax liens, right? And so let's take a look at my actual first investment in tax liens. $2,300 is what I paid for my first investment. And this property, actually, the property that you see actually had a tree through it. This is what I mean when I say I buy the most ugly house or the most despicable house that you can find that people feel like should actually be a tear down, because the tree was actually straight through the middle of this house. And for most people, that would just be so intimidating. I'm not going to lie, I was intimidated too, but for $2,300, I knew that I could figure it out, because this house at the time maybe was worth about $60,000. And so I knew that this property would be a great rental, and if I could just figure out how to get that tree off and get it fixed. And actually that ended up not being such a bad thing. It just really required someone to cut that tree up, remove it from off the roof. I had to get some framing done and then just repair the roof. So that was pretty much it. So that actually ended up being great, and it taught me that, you know, some things look a lot scarier than they really are. So, but a lot of people actually don't believe that you can buy tax liens for this amount. This was 10 years ago when I bought this property, but there are still properties and inventory on the courthouse steps for this amount. Now, this particular property in the same county would probably go for about 10 times today what I paid for it then. So you probably picked this property up for $20,000 in the tax sale. However, the value of this property has also doubled. So tax liens flow with the traditional real estate market. When inventory is high, the prices of tax liens are going to be higher, but it is still the lowest point of real estate that I have seen to date. So secret two, there really is still inventory out there for pennies on the dollar. A student of mine, and please forgive me, I have not updated my slides in a while, so this was in November of last year that she won this property. She won this property for $4,200. It's a townhome worth $70,000, right? But I do have students that I have taken to auction this year, and they have won properties for as little as $5,200. I have a student last month actually purchased a commercial property for $4,200. So it is still out there. Secret number three, the majority of homes that are still on the list on auction day are vacant. And so if you have ethical dilemma with purchasing tax sale properties with people in it, or you feel like you're going to displace a family, you can create a business model that you will only buy vacant tax lien property. So this is what I personally have done for my 10 years in tax lien investing. Owning real estate free and clear. This is significant, and so a lot of people have trouble actually wrapping their mind around this, because a lot of people actually buy real estate with mortgages, and so they don't fully understand the true benefits of owning real estate free and clear. So owning real estate free and clear allows you, obviously, one, to keep more of the money if you sell it, if you wholesale it, if you fix it, or if you are a buy and hold landlord like me, you're going to be able to keep the rent instead of having to pay a mortgage, which allows you to also be able to leverage the property if you need so, and also it also will allow you to be able to set your own rental rates, right? So it definitely has its advantages. So let's take an actual look at the process in Georgia and how it actually works. So in Georgia, if Divine A Home Oh, I'm sorry. I think I went too far. There we go. Divine absentee homeowner fails to pay his any county Georgia property taxes on December 31st, 2016, and on January 1st, any county in Georgia by law has to place that lien on the property. They now have the right to sell the property. That happens automatically on January 1st. So arbitrarily, let's just say the first Tuesday in June, Divine homeowner tax levy is auctioned off to Tasha High Bidder, who is issued a tax deed. She paid $1,000 for that tax deed. Divine A homeowner can redeem that tax deed up to any point until Tasha High Bidder forecloses on his right to redeem. Tasha High Bidder, however, cannot start the foreclosure process for 365 days or until June 7th. If Divine A homeowner redeems at any time on or before June 7th, he must pay Tasha High Bidder the $1,000 plus 20%, so for a total of $1,200. If Divine A homeowner does not redeem at any time on or before June 6th, Tasha High Bidder can then start the foreclosure process, and that's why she looks so happy. Tasha High Bidder will be able to take possession of the property once the foreclosure process is completed, and that typically is 45 to 90 days. It must be 45 days minimum by statutory law. That process typically, on average, will cost about $1,500, and most likely you will need to hire an attorney to complete that process for you. If Tasha High Bidder wants to sell the house at that point, she can do so. However, she will only be able to sell it via tax deed. She does not have a warranty deed at that point. If she wants to sell the house via warranty deed, she will have to file a quiet title action, and that is an actual lawsuit that she must bring against anyone having an interest in the property in order to be able to clear that title. Either way, Tasha will receive her initial investment plus 20% or possession of the property. She will not receive both. It's one or the other. All right. Well, I'm going to skip over this slide of why wait a year because I do want to give you all time to answer some questions, to ask some questions. I am going to open questions. I do want to let you all know I have a boot camp coming up. So if you're interested in learning how to be an actual tax lien investor in Georgia, we have a boot camp coming up this weekend. So other than that, I'm going to open up the floor for questions.
All right, great information, Chantelle. We did have a number of questions, and I would encourage anyone who's got some more as we go along here to ask them, but we'll kind of jump in. One person asked to repeat the formula of 72. I can do that. The rule of 72, it's kind of a unique when you're investing in a tax deferred or tax-free universe, like using an IRA account. You divide your rate of return into the number 72, and that will tell you how long it takes for your money to double. So, for instance, if you had an interest rate of 12%, 12 into 72 is 6 times. Your funds will double within 6 years. If you have 20, as Chantelle showed, 20% return divided into 72 is roughly 3.6. So it'd be 3.6 years. So the rule of 72, it's just you divide the rate of your return into the number 72, and that will tell you how many years it will take for your money to actually double within a tax-deferred universe. So just wanted to state that. Let's see. One question said, someone said, where does the mortgage holder fit into the process? And along that same line, someone asked, why would a bank allow an investor to buy a lien at a much lower amount than the mortgage? So maybe you could tackle kind of both of those at the same time, but where does the mortgage holder, like the bank, for instance, where do they fit into this process with the tax liens?
Okay, so the bank has a mortgage, which is a lien on title. However, they also are responsible for paying the taxes. So if the taxes are not paid, the county does not care where those funds come from. And so they will put a lien on the house. So the bank, just like the homeowner, also has a right to redeem. So they can actually come and redeem that property, pay the investor what was paid at auction plus 20%. However, if they do not, and the investor actually starts the foreclosure process, and a lot of people have trouble wrapping their mind around this, they will lose their position because they will also be foreclosed upon. So in essence, tax liens can actually wipe away a mortgage. I've wiped away many. So, and it could wipe off any other lien. So anybody that has a lien on that property can also come and redeem the property. So not just the mortgage company, but if a creditor has a lien, or if there's a second mortgage company that has a lien, anybody else that has a lien can redeem the property.
And so again, the question is, why would a bank then allow an investor to buy a lien at a much lower amount? I'm guessing a lot of times they probably don't, but sometimes I'm assuming they get missed.
Yes, a lot of that falls through the cracks. Also, in many cases, the bank has already recouped whatever funds, they have a threshold, and so it may not be of value for them to actually redeem the property, especially if it's a property that was bid up, so maybe the initial mortgage was $300,000, right? And let's say the person has paid that down to $50,000, and now at auction, it got bid up to $100,000. Well, the bank is going to say, that's not worth it to us. So now we have to pay $120,000 to get this property back. Well, we've already recouped our money. So a lot of times they will and sometimes the bank can't afford to redeem the property as well. And then in many cases, it's just where the bank let it fall through the cracks. And a lot of these banks, I hate to say it, they have insurance on the property. 9 times out of 10, if it's going into a tax sale, if it has a mortgage, it's probably in foreclosure as well. And so they have mortgage insurance, so they just elect to get paid out through the insurance. It's the reasons vary so much. As an investor, though, we just know that we get our 20% and then we can wipe that off, But a lot of people do have trouble actually believing that actually happens. But, yes, it happens every day, all the time.
Another question somebody asked, is a quiet title action a lawsuit? And you said yes to that. That's a legal procedure. You'd want to either get an attorney or someone involved to help you file it. It's actually, you are filing a quiet title action. It is in a form, a lawsuit, to make sure that any other potential claimants against the property are eliminated, correct?
Yeah, so there's 2 procedures, and so I know I was going a little fast. So one is the actual foreclosure, which is not like your traditional foreclosure. It's actually a foreclosure of right to redeem. So you're just foreclosing on someone's right to redeem. And then the second process, so that process you can either do pro se or you can hire an attorney. Obviously, I recommend people hire an attorney. So if it's done incorrectly, you can fall back on their errors in insurance. However, the second process, in order to be able to obtain a warranty deed, is the quiet title. And, yes, that's an actual lawsuit, and it has to be typically done by an attorney. So, but it's a lawsuit.
And somebody asked what court is that done in? That's just a local circuit court, or?
It's done in Superior. Typically, it's done in Superior Court.
Okay.
Yeah, but the local court of that county, whichever county the property lies or parcel lies, is the county that it would be done in. And typically, that's going to be the Superior Court. But every state different, so that person would have to pretty much contact the county and ask that information.
You had talked earlier, you were talking about tax liens. You were saying, finding perhaps vacant property. Someone wanted to know kind of what do you do, or how do you know if a property is indeed vacant that you're bidding on?
Sometimes you don't know, because sometimes you don't have – tax lien properties are not your traditional properties where there's going to be a lockbox or the county's going to give you a key. There's not going to be a real estate agent that can show you that property unless it was originally for sale anyway. So many times you may not know. But over doing this for 10 years, there's a lot of signs that you can look for to see if a property is most likely vacant, Obviously, the ones that are very vagrant are, typically vacant. They typically have the door is wide open anyway. But then other things could just be the wear and tear of the exterior of the house, the yard, those type of things. The mail piling up in the mailbox, those type of things.
Okay,
So,
let me see.
But, yeah, in some cases you won't know.
Let me see another question here. We pull one. Someone said you said mortgage and homeowners are responsible for paying the property taxes. So anyone with a lien can redeem the tax lien. Would that also mean lien holders like contractors who can take away investors' right to foreclose? I think you meant, I don't know, correct me if I'm wrong, but if you have a lien against a property, you could potentially foreclose, but tax liens take a little bit different priority than perhaps a contractor's lien.
Okay, yeah, so the tax lien is going to supersede, let's say, a contractor's lien. But the contractor who has a lien on that property can redeem that property from the investor because they originally had a right before that tax lien was placed. So they have a right to then redeem. So if a contractor is owed money, they place a lien on the property, it goes into the tax sale, the homeowner hasn't redeemed, the actual contractor can come to the investor and say, I want to redeem the property.
All right. Another question: what is the secret for an individual to compete and win against the banks or the larger groups? Kind of what is what's one of your good secrets you can share with us?
Okay, right. So the secret is that most people who actually get into tax lien investing, and a lot of courses will teach you to only find maybe 5 or 10 properties because you're dealing with a list of 100 plus properties that are going to a tax sale at one time, and it could be up to 800 properties. So a lot of people don't have the time, resources, or inclination to research 800 properties. So most people will only research 5 or 10 properties. Well, the trick is to research as many off that list as you can. So that opens up a pool of options. And then typically there may be some that the big boys or the banks did not want that you can still get. But if you only research 5 properties, 9 times out of 10, you're not going to win a property at auction because somebody else is going to want those same 5 properties, and you're going to get outbid. So.
Okay.
So I teach my students to do due diligence on everything. If you can do that whole list, do the whole list. I've seen many people walk away with anything, whereas I've done the whole list, and I may have only walked away with 1 or 2, but really for people like us, that's all it takes is 1 or 2. So.
Somebody asked a question I can't answer. Said, if my self-directed IRA purchased a tax lien and I require financing to fix it up to resale, is my IRA subject to UDFI tax if I now own the property versus financing the purchase of property, which normally triggers that? The answer is yes. If you buy any real estate with your IRA account and you use leverage in order to fix up the property or even to purchase a property, when you sell it, that does trigger UDFI tax to the IRA. But if you're just buying a tax lien, getting the property and then selling the property, or if you're buying the tax lien that's just simply being redeemed, no tax implication whatsoever to your IRA. So it's kind of a very special case that question popped up. A lot of people asking about kind of the sources where you can find the properties are available. There are lists online, either in Georgia or perhaps, I don't know if you know of other states as well. They either list the properties online or they can also actually do some of their auctions online as well.
Right. So every state is different, and within those counties is different. And so some of the sources, one place that you can always find tax liens, most people don't like this one source, but this is guaranteed, is in whatever local or legal organ or little newspaper that the county is required to put those notices in, because they have to give the homeowners notice. So that is one place that you can always find it. Now, that's going to require typically some manual work, or subscription to that newspaper, but that's always guaranteed. Now, typically, a lot of counties do have that online, so you're going to either contact that county or you're going to go on their website and you're going to have to search for that list. They don't put it in an easy place to find. Like, this is a secret billion-dollar industry. Banks try to keep it that way. So it's not always easy to find. So, yes, it does require some researching. But that one place is always guaranteed because that's by law.
Yeah, a couple questions here, kind of all going around the realm of due diligence, and people asking, like, one question is, do you see the property? Do you get to see the property before buying? And then obviously, what kind of research are you doing on the property? What would you be a couple key points of proper due diligence? So I'm assuming you could look at the property. If you find the property online, you can just drive by and look at it if it's in your area, correct?
Yes. So that is definitely one due diligence that I encourage everyone to do, because the county does not do any due diligence. And so sometimes it may not actually be a property. It may be a piece of land, and it may be a piece of land that actually sits behind someone's property. And so these are things that you would want to find out before you purchase. So I don't encourage people to buy properties sight unseen. Other due diligence you may want to do is you want to find out the value of the property. If you're a buy and holder, you want to know what you can rent that property for. You want to know what type of property it is. Is it single family? Is it residential or commercial? Is it land? You would want to know the ARV or the actual value of the property if you're a wholesaler, So those are some of the things that you're going to look for.
Another great question. Someone said, once you actually buy the tax lien, so you found it online, you did your research, you did your due diligence, bought it. During that first 365-day period do you have to attempt to contact the parties that may have a legal interest in the property? And if not, if you don't have to, is there a point at which you should?
Okay, so no, you don't have to, and that's going to be what your business model. Obviously, if you're an interest investor, as soon as you can get your money and redeem it, you can go reinvest it. But if you're a property investor, some property investors but during the foreclosure process, that is actually what the foreclosure process is. It's a legal notice to anyone that has an interest in the property that their right to redeem is ending. And so you have to contact them at that point.
Right, and Chantelle, you cut out a little bit during your answer. I'll just recap again. Yeah, if you're buying for mainly the interest, you might contact people then to actually, hey, does somebody want to pay me off and I'll get my money back and reinvest it? But if you're looking for the property, that's a situation where maybe you don't alert everybody to the fact of what's going on. So I think that's a great answer. A question for me. It's in a self-directed format. If you win a property, is there a way for the investor to manage a rehab or work on the property? Now, if you own real estate in your self-directed IRA, so if you've purchased a tax lien and redeemed the property, and you have that property now, the rules do prohibit you from working on the property yourself, actually swinging the hammer. Our interpretation of the rules, though, if you wanted to manage the rehab in the sense of you're hiring the contractors, you're deciding what work needs to be done, and your IRA is paying for that, that is acceptable. But as far as you doing any of the physical labor on the property, we do think that is indeed prohibited for you to do. So, Chantelle, we had a lot of other questions. I don't think we're going to have time to get to them all. I would just say, if people who are interested, go to Chantelle's website. Here, I'll put up all her social links as well. Because somebody said, actually, we'll go one more question. Do we buy Georgia tax deeds through the county tax sales only? And when do these happen typically in Georgia? I'm assuming every county and every state's going to be different as far as their when they actually put the properties up for auction. But at least in Georgia, when are typically the buying periods? Is it once a year or is it an ongoing basis?
So every county is different. Some counties have once a year, some have every month. But if they have inventory, it's going to be sold on the first Tuesday of that month. And so that's where they, will go to auction, is on that first Tuesday.
One other good question: do government liens survive the tax deed sale in Georgia?
It depends on what type of government lien it is. If it's a county lien, yes, but any other lien, and I would probably need to know that what type of lien. I can't just blanket it, but it has to be some type of county lien to be equal. But most other liens would be wiped off. So even like state taxes are wiped off. Federal taxes are wiped off.
Let's see, one other good one here. Just someone said if you bought a tax lien, it turns out the property is in probate. Do you know how will the investment process be done? How long will it take for you to take possession? I mean, I don't know if you've had experience, if you've had that happen where you bought a tax lien, the property is actually going through the probate process. Any do's or don'ts with that scenario?
Yeah, it's just a regular scenario. If the state wants to redeem it, they will also have to pay what was paid at auction plus 20%, because either way, it owed taxes, and those taxes had to be paid. So it won't trigger any delay in that year process. It's just that they do still have any heirs also have a right to redeem. If they don't, then you would foreclose on the state as well.
Somebody did ask, what about an IRS lien?
It supersedes it, and they can also be wiped off through the foreclosure process.
Okay. Let's see, one person did ask if they can get a copy of the slide deck. The answer is yes. We can email that out to everybody who registered for the webinar. So we'll get that out here in a few days along with a copy of the recording. And Chantelle, the last question I'll leave you is, what's the best way someone asked to continue to get educated on tax liens for the state you're in? This person turns out to be in Florida. Is it typically online, or is there a course, or is there something they can contact you? I don't know if you have people in other states that you know of that you work with.
Obviously, if they're in Georgia, I'm going to be biased and tell them just to come to me. But there are some national programs that teach tax liens. I don't know any in Florida per se. So I can't. I did have one, but I'm not for sure if they do Florida. So, I mean that's really a Google search, really, to be honest with you. But I don't know any that I can actually recommend.
Yeah, I was going to say the same thing.
I would say most people really do need to take a course, because it really is going to take you. It's a long learning curve on your own, is what I can say.
Yes. So. Well, this time, Chantelle, I want to thank you again very much for your time. Everybody if you asked a question, unfortunately, we just didn't have time to get to them all. We had so many questions, but I did my best to get to as many as possible. But again, you can reach out to Chantelle individually, maybe try to find, get some your questions answered or find out more about what she does. Chantelle, again, thank you very much for your time today.
All right. Thank you, Scott, for having me.
All right, and again, thank you all for listening to the recording, and I encourage you to attend other webinars that we have. Try to bring as many great speakers as we can. So again, thank you very much for your time.